Hey everyone. The greatest challenges facing the commercial real estate sector largely stem from the Federal Reserve's aggressive rate increases over the last 15 months. Pushing the overnight rate up by more than 5% in such a short time has created 5 significant challenges for the commercial real estate industry. To start, the rate increases have, obviously, raised the cost of debt capital. In 2021, investors could access commercial real estate loans for as low as the mid 3% range. Today, most commercial real estate lending rates run somewhere between 5.5% and the mid 8% range, depending on the property type, the location, leverage, term, borrower strength, etc. That dramatic rate increase has structurally changed the commercial real estate market, redefining property values and investor expectations. The market also faces distress risk as the interest rate surge pushes some properties with variable rate debt into a negative cash flow position. As a result, some investors may need to recapitalize assets or feed cash into the properties to keep them afloat. In addition, properties that have an existing loan that's coming due could also face cash flow challenges as the old loan matures and owners refinance at the new, substantially higher rates. In those cases, operators may need to add capital to align with new loan-to-value standards or to meet more aggressive debt service coverage ratio requirements. This has the potential to force some investors to sell properties that no longer pencil, especially assets that have underperformed for the last couple years, like urban offices. The third way higher interest rates are affecting commercial real estate is by pulling capital out of the market and into bonds. Both the 3-month and the 6-month treasuries have been delivering yields in excess of 5.25%, which is a pretty attractive risk-free rate. This has given investors a reasonable return on parked capital while they wait for the commercial real estate market to reprice. Because short-term bonds have been paying a rate north of 5%, investors expect commercial real estate to offer cap rates that deliver some level of risk premium above that. Where those cap rates will ultimately land remains uncertain. There's still considerable variance between the different property types, asset classes, and locations. The fourth challenge investors face is tighter lender underwriting and a shrinking volume of debt capital. Although lenders remain active and debt is widely available for most property types and locations, banks have tightened their underwriting and reduced their lending so they can shore up their balance sheets. Since the bank runs forced the closure of Silicon Valley Bank and First Republic Bank, most small to mid-sized institutions have reduced their lending so they can build their reserves and mitigate risk. As a result, locking in debt capital has become more challenging, and in some cases, lenders have walked away from deals late in the process, leaving borrowers to scramble for debt capital at the last minute. That, of course, can make it more difficult for investors to close transactions. And all of these issues lead to the fifth problem. Buyers now require a higher return on commercial real estate, and many property owners are choosing not to sell at the current market clearing prices. That pricing expectation gap is restraining transaction velocity. So, what will it take to reinvigorate the commercial real estate market? I can think of a few ways this could happen. One thing that would cause opportunistic investors to rejoice and prices to reset would be to go through a wave of defaults. But this remains highly unlikely for most property types. Delinquency rates are closely tracked for CMBS debt, and only office properties are showing a material rise in late payments. Office property CMBS delinquency rates are up about 125 basis points in the last month, but they're still only in the 4% range. That's quite low from a historical standpoint. Another relatively low probability event that could free up the markets would be for the Federal Reserve to reduce rates. But the Fed has reiterated multiple times that they don't expect inflation to fall enough to make that a likely path, at least not this year. In my opinion, the most likely path to a more active commercial real estate market will be through interest rate stabilization. That will enable the markets to recalibrate and normalize. Over the last 15 months, it has been very difficult to underwrite assets amid the shifting interest rate landscape. If rates flatten and the Fed signals that rates will likely remain stable for a while, the market will begin to normalize. We've already started to move that direction. So although pricing hasn't fully stabilized and there are still questions about what will happen with interest rates over the short term, we appear to be on the backside of the commercial real estate market disruption. That's a short-term perspective. When investors take a long-term perspective, the opportunities available today may become more apparent. Remember, commercial real estate is often best viewed in a long-term context, and investors may see opportunities when they keep their eyes on the horizon.